So without further ado, guys, if you've got any questions, as always, you're welcome to put your hand up and ask a question. Also welcome to put it in a notes section, and we'll deal with it as soon as we can. We will have some time at the end as well for questions if you wanna wait till the end with your question. On our agenda today, we got 3 items for you. So a normal market update by Ian, and we've tried to keep it really short and sweet, but give you quite a good overview of sort of the lay of the land, and maybe even something with a handful of slides that you can go and articulate back to your clients. So Ian will take us through that. Tawanda is going to take us through the equity and the flexible section of the shortlist, which will be an interesting session, I think. And then lastly, we're going to talk a little bit about structured notes, which is something we've been using for quite a while at Seed in our funds. And it's an offering that we want to make available to all of you guys. So hang on for that at the end. I think that'll be quite exciting. As I hand over to Ian, I think it's been a exciting ride so far this year. We're kind of just over halfway, and a lot has happened in this first half of the year. I think we're at the point now where interest rates are probably close to peaking. I know we're all holding our breath for the local interest rate announcement later this week, where we expect probably another 25 basis points, sadly. I know we're all hurting already on the bond and car repayments, but it seems like there's some more pain to come. And whilst that the market's been sort of looking at these interest rate hike cycles and sort of starting to price in the end of it, we're also really looking at the earnings season globally now, with companies reporting their earnings. And we're seeing that driving the market. The banks picking up quite nicely in the US yesterday after they surprised on the upside with their earnings announcements. So a very interesting period that we're in on the investment side, as always. But Ian, over to you to give us a few more insights, please.
Good morning, everyone. Thanks, AD. Good to be with everyone. And yeah, I think as AD said, relatively short and sweet. But I thought let's start with this quote. This is from a guy, John Galbraith. He was actually an economist, and it's interesting what he said. Yeah, the function of economic forecasting is to make astrology look respectable. And I think at so many times that's what it feels like. You know, you can make all these forecasts. There's so many forecasts out there, but man, oh man, so often it can be wrong. So I just thought that's interesting, and that's coming from an economist. So let's delve in and look into just some of the return data. This is just high level. I think we all know this, but it's just useful. This is up till end of June. So these numbers are all in dollars, except for the South African market. And yeah, it's been okay-ish on the SA market, up 6% till the end of June, and we've obviously picked up. It's been all right, but not nearly as much as what we've obviously seen in the US. So generally, what we've got here is emerging markets, and China is the big one that's pulled back, minus 3.9. If we obviously price SA in dollar terms, it's also gone backwards this year. Obviously, we've seen the dollar, rand dollar, go negative. So emerging markets struggling, but man, oh man, the US, and this is obviously the S&P, which is the broad 500 index, up 16.9, 17%. And then the rest, everything else pretty mediocre by comparison. Gold, just put that for interest sake. It's been sort of up, down, but pretty flattish, not really doing anything great shakes. So yeah, just those are the returns on the asset prices on the indices that we have to work with. So if we look at some of the detail, and these are just high level sort of things that we sort of looking at on the SA economy. Yeah, I think the big one is the inflation data. We've got the latest data coming out today, this morning, and the sort of expectation is for sort of 5.5%. But for the year, the sort of number in excess of 6%. Fitch is looking at 6.4, so 6.4, 6.3, maybe we'll be surprised on the downside, but it's higher than what the Reserve Bank is wanting. And that's why, there's a good possibility that we'll still see an interest rate hike next week. So their next meeting is on the 20th of July. 20 this week, sorry, tomorrow. Inflation out today, and the meeting tomorrow, the announcement tomorrow. But we've got low consumer confidence in SA, and we know that's a problem. We've put here, I mean, there are some signs of improvement, and I know we sort of have to look far and wide to see that. But I think a big one that, maybe we're only at the start is sort of the privatization of so many things. And the privatization, so to speak, of energy is possibly one area where, the government is just really battling. And we know there's a long way to go. But we saw some announcements yesterday as well on the port side. So I think, private has to really take things into their own hands, and that's what we're seeing. There's also been a little bit of a subsidence of the sort of maybe the concern about the sort of, I put there in inverted commas, sanctions. We were obviously worried about the immediate sort of stopping of the AGOA agreement. It looks like that may have subsided a bit and put to the back burner for now at least. But that is a concern because this AGOA agreement expires in 2025, next year, year of next, and we shouldn't really actually be there anyway. We've got a bit of a free pass into that agreement, so I can foresee that there's going to be a little bit more concern in terms of extending that down the line, and that's a problem. If we look at we know this, the currency. This is a long-term chart. This is something we all know. Our clients all know this. But I think what's interesting is that it while the long-term trend is negative against the dollar, it doesn't go in a straight line, and we've seen that now as the currency has appreciated from its very weak levels. And from time to time, it does that. It overshoots, gets very negative very quickly, and then there's a degree of pullback. And we've seen obviously a degree of pullback to its current levels at below the 18 level now, and that's obviously not apparent on this chart. So this month has been good, but year to date, it's been pretty weak as it flew all the way through to those exceptionally weak levels. But and this is always the issue for clients wanting to take money out. I suppose caution is always warranted where you've got this very rapid sort of sell-off. And time and time again, I mean, the currency does give an opportunity in terms of coming back to a little bit more realistic levels, where clients can maybe think a little bit more rationally about how to do things. So that's our share price, SA share price, we call it. Yeah, and then you've got this fear and greed index, and I've put this one up. This is the South African fear and greed. They call it the fear and greed index. This comes from Skulk Low. We consult with him, and then on the next one, which we'll look at just now, is the US. And this is made up of a number of indicators. This particular one is 5 underlying indicators. It's like a sentiment indicator, and it oscillates pretty rapidly between fear and greed. And generally, it's a bit more of a contra indicator. So typically when things are too exuberant and there's sort of greed, it's a time to be a little bit of caution, and vice versa. When it's indicating extreme fear, typically that's not a bad time to be sort of thinking, okay, we can allocate. So yeah, it oscillates quickly. You can see there, if we look back, beginning of the year, it was in the greed area, and we had the China opening up. Things were looking a lot more positive, but it quickly fell down, and we've had a lot of issues along the way. And I think the current one is really, what I call the sort of polarization and sort of emerging market negative views at the moment. And it's coming into, it's more of the fear stage. So maybe a bit of a contra indicator there. If we look at the US fear and greed index, so this is something it's, again, CNN puts out. You can access it. It's based on 7 underlying indicators, as I say. So it's a type of a sentiment indicator giving a sense of the sentiment of the market. And yeah, you can see there a year ago it was in the fear zone, but swung very quickly now. This last year to date, mostly into the sort of greed stage, and it's understandable. I mean, things are looking so good from a market perspective, in terms of momentum, price strength, low volatility, the amount of put call ratio. So there's a lot of factors that come into this. And again, maybe sometimes a little bit of caution might be warranted when it's at these extreme levels. So that's quite interesting. If we look at some of the and this is one factor that's actually driving that sort of greed sentiment. And we've briefly touched on the sort of AI boom. It's obviously extremely topical. If you take these 10 stocks, AI stocks, and track them, I mean, the trend this year, this is just year to date, has been absolutely crazy. I mean, Nvidia and Microsoft, we saw jump up 4% yesterday, as it's looking at pricing in a $30 a month price for access to some of its AI stuff. And so these stocks have just been absolutely on a tear. So while the broad index is up 17%, fantastic, these particular stocks have really driven up that market. So you really had to be positioned into these stocks, Meta as well. So this is driving the sentiment to exceptionally positive. If you look at some of the underlying economic issues, it's you can also see it hasn't been bad. I mean, GDP surprised a little bit on the upside in the first quarter. You've got this continuation of exceptionally low unemployment levels, ranging 3.5 to 3 points. I mean, it's exceptionally low levels of unemployment. You do have the Fed still trying to cool down, and so far it's working. And we'll look on the next chart. But this is next week, is obviously the US looking at possibly another 25% interest rate. In fact, the market's pricing in, there's a 100% possibility that it's going to be priced that another 25%, 25 basis points next week. So we've had this interest rates up. The market expects at this degree that these interest rates will remain high for longer, but at the same time, markets are forward looking, and they are looking through all of this. So far, it hasn't really hurt valuation. It hasn't hurt the valuations too much. It hasn't hurt the earnings too much. And then you've got this added element of these AI stocks just continuing to push up. So the market's looking through this interest rate cycle. And then if we look at the next chart, what's starting to happen quite relatively quickly is this decline in inflation rate. And this is obviously what's the market is saying, you know what, we're reaching the peak now of interest rates. And yes, there might be, but higher for longer. Maybe we're going to hit a point where inflation starts to get a little bit sticky at these levels, and that dotted line is the 2% level. That's where the US central banks need that inflation level to be. But we're looking through this, and markets are forward looking, and they always are. And this is why we've had prices race ahead. The issue is, have they moved ahead too quickly? And that's always the difficulty, trying to ascertain, are they too exuberant? But the bottom line is inflation is coming down, and it has come down from this exceptionally high peak levels really quickly. And this is the core inflation and the headline inflation. So the core inflation is what the central bankers do look at, but the two move ultimately in tandem. The big factor there's been the negative has been China. It's also a big negative for us. So China's economy, contrary to the Western world and especially the US, has been pretty lackluster. You've got a range of factors. You've got exports and imports contracting. You've got weak consumer spending, and that's the big one. Ultimately, it's not a consumption economy. They've over time trying to get more consumer spending, but the bottom line is Chinese do save a lot. They do have high savings rate. They don't go out and spend, so they need demand coming from the West ultimately. And obviously the geopolitical tensions is not helping. There's a high degree of sort of onshoring back from US companies saying, we've got to pull back a lot more of our production. So slowly but surely, we've had this downgrade in the GDP forecasts. And a big factor, which is coming through a lot more now, is just the sort of infrastructure stroke property bubble, maybe to some extent, that China had. And so there's been a slump in this property investment, slump in property sales. We've had that big Evergrande company come out. I think it came out yesterday with some numbers. I mean, the losses that this company has generated over the last couple of years is way into the billions of dollars. I saw a number of 81 billion. I mean, it's just huge. So there's big problems there in China. And what the market's been waiting for and trying to call for, and to some extent China needs it, but so far it hasn't happened, and that's a stimulus. To try and stimulate that economy again. So far, they've been a little bit reticent to do it because there's a high degree of gearing in that economy. So we haven't really seen that too much, in terms of just lower interest rates. You've got the inflation rate that's come all the way down. But so I think at some point, it's happened time and time again. I think at some point they're going to have to stimulate the economy and put some more, ultimately more currency depreciation into that economy and try and hype it up a bit. So we'll see. So far it hasn't happened, but we need that as well from our perspective. So this is I look at that as a bit of a sort of indicator on the Chinese economy, so to speak. So we can see the commodity prices slumping down dramatically over this period of time, and weak. It doesn't help. It doesn't help the SA economy. We're going to have weak revenues, weak profitability from a range of commodity companies. We've seen the platinum, palladium, iron ore, a whole bunch come down dramatically. So this is an indication, obviously, of the demand or lack of demand coming out of the China. So that's not really helping too much. So China's a little bit of a problem, and we do have an allocation to China. So it's across the board. It's not only obviously on the industrial companies, it's on the tech companies as well. They've really struggled. So in conclusion, I think what we've definitely seen this polarization of market performance. And the question then is, maybe our valuations are too depressed on the emerging market side. South Africa, as an example, China, and too euphoric in the US. As I say, when I see, I think between Microsoft and Nvidia yesterday, just yesterday's performance, they put on I think it was $175 billion of market cap valuation. I mean, Microsoft as a huge company goes up 4%. So it's exceptionally euphoric in the US, driven to a large extent by the AI. And maybe a lot of those earnings ultimately come through, but maybe, and that's why I put a question mark there. Maybe it's just too euphoric, and maybe too depressed in the emerging markets. But markets have a way of getting a lot more stretched than what many people think, and that's what it has been happening. But they definitely, from a US perspective, definitely pricing in the sort of soft landing, low inflation, peaking of interest rates, and ultimately no recession. And we will see. So far, it doesn't look like there's any recession, but we will see what happens. At the same time, as I say, from an SA perspective, we need the strong China. We need a bit of stimulus coming out of China, we need firmer commodity markets. And to some extent, we need a bit of improvement in investor confidence. So, and these things can turn pretty quickly, especially when things are stretched, both on the euphoria side and on the depressed side. Doesn't take much in both instances. So, again, I think I'd take out, and we'll look through some of the detail, but we'll never go 0 in one and 100% in the other. So, it's just a matter of fading a little bit, not totally buying into the euphoria, but not being out of it, and not saying, okay, let's go all into valuations. So, you never want to do that. So yeah, that gives a little bit of a sense. Happy to answer any questions, or maybe you've got some questions coming out of that, or even at the end. So back over to you, Adi. Thanks, guys.
Thank you, Ian. One or two questions, Ian, relates more, I guess, to the broader question around the US debt burden, but with the Biden administration potentially pushing to write down student loans, with the impact of that potentially on the US economy is the first question.
Yeah, there's obviously a lot of concern, I think, globally, about the debt load and the ability to meet that debt load. And I think the student debt, it's a big one, but it's just one component of the total US debt. The way I look at the total debt, and let's specifically in the US, it can go a lot longer, way more than what people think it can. Similar situation to here, and I can see, I mean, the IMF is concerned globally about the debt levels, but these things can go for a lot longer and for a long period of time. So there's concern, how, the interest rate. You've got the high debt load, and then you've got the interest rate, the higher interest rate. So the strain on the fiscus is huge. I mean, the numbers are just astronomical in terms of the interest expense. It's by far going to be the biggest expense that government has to pay. So I don't know. I mean, we've seen the dollar come down a bit, but all currencies ultimately float one against another, and that's an indication of all sorts of factors. All I can say is, my view is that debt levels can just go for a longer period of time, especially at the government level. They've got all sorts of means to figure this thing out. So I'd say it's a concern, but I wouldn't lose too much sleep about that particular one. It's just you just got to take that and just say it's just one component of the overall picture.
Thank you, Ian.
Maybe I can add one thing to that is often ignored. I think it can actually have a positive impact on the overall economy from a GDP perspective. Yeah. And the way that you would consider that is, if the debt burden is taken away from students who have started working, then that means more disposable income for them. So they've got a lot more to spend into the economy. And from an overall GDP perspective, then that can actually have a positive impact on the economy. Rather than just looking at it from a fiscus perspective, it can actually positively impact just based on the amount of money that people have to spend into the economy.
That's it. It's a good point. Absolutely, very good point. And I think that is often missed, because you just the focus or the headline news is wanting to sell the bad news constantly, and we have this internal debate all the time. You have this focus on the headline negative news, and quite right. One is pointing out there the corollary there's often a positive. So yeah, it's a good point.
Thank you, James. Second question relates, I guess, to around where world growth is coming from and sort of geographical investment opportunities. So I know the expectation is sort of for the next 5 years, China will probably be the leading contributor to world growth, followed by India and then the US. And the question relates to that from investment opportunities in India, and also relates back to sort of that focus on the de-dollarization, particularly in the East. T-Matt, I don't know if you want to maybe pick up that question just from, I know in India, although it's maybe a high growth area, structurally not always that easy to find solid investment opportunities that ticks all the right boxes.
Yeah, but it is a growing opportunity. So diversification is key. I think most investments globally are probably on the Western side. So you're talking of US and Europe. And as investors have looked to diversify away, then obviously looking at emerging markets, which on a valuation perspective have looked more and more attractive. And if you now and you have to take it away from the de-dollarization or currency. It's more about finding underlying opportunities, and China and India over the last few years have actually been areas in emerging markets where you can find good underlying companies or good opportunities. So yes, for sure, in terms of going forward, with an expected faster growth rate within India, then you actually tend to find more opportunities in that economy, and more and more investors are looking in that direction. And this also speaks to kind of like some of the points that Ian has been highlighting on China. I think China was always the easy place to look at in terms of emerging markets and diversifying away, but there's been a few challenges with China. So when you start to look at other economies, then India does offer opportunities to diversify away.
Thank you, T-Man Martinez. I hope that answers your question. Any other questions for Ian before we move on to the shortlist by T-Man? All good.
Thanks, guys.
Shall we go into the equity and flexible section of the shortlist and some insights around that, please?
Yeah, perfect. So we're going to go through more call it the moderately aggressive and aggressives. So funds that are looking at delivering higher growth, so higher returns for your clients. So if you're looking at the more discretionary type of investments, then you're looking at this flexible and equity section. So flexible is a multi-asset fund. What the flexible funds are really trying to do is to deliver equity type of return. So call it something fairly similar to the all-share index, but then do that at a lower than average volatility. So in comparison to what your equity funds are delivering. And what you see, we've got 3 funds on the shortlist: the 361 Flexible Opportunity, Truffle Flexible, Truffle Flexible, and the Batalia Flexible Fund. And a key feature between these 3 different managers is they've been in the industry for a very long period of time, called 20 years, or more than 20 years, managing hedge funds. And when they've come to manage these long-only funds, they've come with a hedge fund mindset, which basically means that they try and manage on the risk side whilst delivering good returns. And the opportunity set that I have in terms of the tools that they can use to build their portfolios tends to be a lot wider than what you're used to, which is why we talk about that flexibility. It's flexibility in asset classes, it's flexibility in the tools that they use, and this includes hedging as an example. So if they need to manage the risk by hedging, let's say it's hedging out a currency risk, then these are the kind of managers that are able to do that within their portfolios. So we've chosen these 3 different managers in as much as they kind of do the same thing in the flexibility. The approaches that they follow in investing are actually quite different. So the 361 as a top-down. So top-down is basically looking at a macro economic approach. And then I've also got bottom-up. The bottom-up is trying to look at the respective shares. So looking at it on a share level, going to pick what you deem to be either the best companies or the companies that offer the best value. So studying the companies, understanding the companies really well, and investing in what you think are the companies that offer the best opportunities. So it's a combination of looking at it from a macroeconomic perspective. So looking at the countries that these companies invest in, looking at the industries that these companies are in, and then combining that with, okay, what are the really good companies within this industry, or what are the really good companies within this cap. So that's the 361 following that top-down macro approach and the bottom-up approach. It's a similar thing with Batalia that also do a top-down and a bottom-up. Trafo, on the other hand, is more valuation-driven. So they look mostly at the shares, trying to do a relative valuation between shares which they think are attractive or not attractive. And that also comes from that hedge fund mindset. So if we look at the way that they're picking the shares, which is what I call the equity style, then 361, we say that they're style agnostic. So I think you guys are aware of value type of investing, quality type of investing, growth type of investing. 361 doesn't really mind whether it's value shares, growth shares, or quality shares. What they're looking for is, at any period of time, is that what is offering the best opportunity, because those styles come in and out of favor. So they try to be agnostic towards a specific style and just look at any particular period of time. What style is offering the best opportunity? Trafo looks at a relative valuation, like I just said, which is just looking at the valuation of the shares and trying to pick which one has the highest possible returns going forward. Batalia, on the other hand, looks for the best quality companies that have the highest growth going forward. And we see an element that comes from that quality and growth perspective as the lower volatility that Batalia fund tends to have relative to other flexible funds. And the type of asset classes that these flexible funds are looking at, 361 and Trafo tend to look at all the different asset classes, be it equity, property, bonds, cash, everything. They tend to look at that. And Batalia historically has tended to focus a lot more on equity and cash. So build a portfolio where, if equities are attractive, then they have a lot more in equities. But if equities are very unattractive, then you can have a lot more cash in the portfolio. So to protect in times when the equities can be under pressure. And more recently, they've also been including the bonds. And I mean, we've spoken to how attractive the bonds have been within the market. I think the one other thing that I can highlight, which is at the bottom there, is the cost. I think this is one of the disadvantages of the flexible funds, just being more flexible and trading a lot more. Then the costs of those funds tend to be a little bit higher. But as we see on the next slide, whereby we look at the performance on a net of fee basis, then these funds tend to deliver on a net of fee basis. So delivering better than average returns, so better returns than the peer group and better returns than the all-share index that I've got there at much lower volatility. So the kind of the thought process when you're looking at these funds is, okay, they do tend to be a bit more expensive, but on a risk and reward basis, are you getting rewarded maybe for the slightly higher cost that you're paying? And on a net of fee basis, then as the history shows here, that yes, you have been able to deliver a better return than what your index is giving you, at a much lower volatility. If we move on to the next section, then we are looking at the equity funds now, and I've just divided the equity funds into the more active funds and then also the lower cost funds, which would be our last section. And then if we just start on these funds, we've got two funds that have a South African focus only. So that's the Coronation Top 20 and the Fair Tree Equity Fund. And then we've also got the 361 BCI Equity Fund, which obviously has an offshore allocation to that fund. As we've already spoken to you, the 361, when we're looking at the flexible fund, this has a top-down and bottom-up approach. And then when we look at Coronation, what they do is pretty much just look at the shares, bottom-up fundamental analysis, understand the companies and invest in whatever they think the companies have the best valuation and will have the best possible return opportunities going forward. Fair Tree Equity, which has probably been the best performing South African equity fund over the last decade. They also have a top-down and bottom-up approach. They also style agnostic, but like I said, with that SA only. And what we've seen from our research is they have a really good understanding of the commodities and the resources, so have been able to take overweight position in the commodities when they offer a great opportunity, and then also go underweight. And they've been able to do that much better than their peers, which is how they've been able to deliver better than average returns. And as you can see, the fund sizes, the fund's actually quite relatively big. So the smallest fund they've been that 361 BCI equity fund at 7 billion. But this fund was also started quite a long time ago in 2005. So you can see how these managers have been in the market for a very long period of time. The Core Top 20 fund since 2000, so it's got a long-term history, but being consistent. I mean, it can be cyclical, but over the long term, it does tend to deliver better than average returns. And if we just look at the costs, so the cost obviously slightly lower than what you get for the flexible funds, but you do see that active management fee that it tends to be a little bit high. Again, like we did for the flexible funds, if we look at the performances, the net of fee performance, then you can see that the funds have been able to deliver better than average returns. But obviously, with the different investment styles that these managers follow, then you can see that the return profiles are quite different. So factory equity tends to be a little bit more volatile than your average funds. It's that style agnostic style that they follow, that they can also be flexible. If they're not happy with how the market is looking, then they can easily change to wherever the best opportunity. So they can trade a little bit more, and they can be a little bit more volatile just based on the type of assets but they're able to pick the good shares that they can outperform and do better than average. So you can see an exceptional outperformance relative to the peer group and to the index as well. Similarly, the BCI Equity Fund has delivered quite a good return over this period since July 2012 at lower volatility. Like I said, this fund also has offshore with an offshore component, so that also helps to minimize the risk within that fund. But they've also got an SA-only version of this fund, and it's also delivered quite a decent return with also decent volatility statistics. And the Coronation Top 20, which can be cyclical, just based on that valuation style that they follow, still better than average returns with slightly more volatility than your peer group. And I'll just round off by looking at your lower cost strategies that we've got on the shortlist, and that's represented by the One Invest Aussie 40 and your Satrix Top 40. So pretty much just passive index trackers that are tracking the top 40 index. So if your clients are really cognizant of the costs and they just want to track the market, then these offer decent opportunities at a lower cost, which is what you see at the bottom there. And additionally, we've also got the Standard Enhanced Multi-Style, which is a smart beta fund. That just means that it is factor-based. So the guys at Standard are looking at the various factors and using a systematic engine. So rather than analysts sitting down, studying shares and trying to understand those shares better, they're just using an automatic engine to try and value the shares, look for the growth shares, look for the quality shares, and build a portfolio based on these different factors. And then that portfolio is what you call that enhanced multi-style, because it's different styles, value, growth, and quality that you put together to build. And obviously utilizing a computer to do this equity selection for them, then they're able to keep the cost a little bit lower. So the active component of it means that the cost will be slightly higher than your passive index trackers, but it's much lower than what you would get for your active managers. And if you just look at the performance data, I've used the trading returns with the gray blocks representing your the peer group performance. So your South African equity peer group performance, and the gray blocks just represent mostly what your active managers have done. And what you can see from this is in the recent past, these trackers and the smart beta have actually been able to deliver quite a decent performance relative to your active managers. And I think it goes to the point that's often spoken about in the industry, that at certain times you might have your passive building blocks outperforming your active managers, which is kind of like what you see from this chart. But I'd also like to highlight that the active managers that we've picked and those flexible funds that we've picked have all been able to beat the trackers and the index. So you still can be able to identify the good active managers that can deliver outperformance. So we're really giving you a variety of funds there, whether it's on the active side or on the passive side. It's all good opportunities offering something different, and it just depends what your clients want, or what your clients want. You'll be able to provide for whatever the needs are based on what the shortlist is giving you. I'll hand over back to you, Adrian. That's it from my side.
Thank you for those insights, Tawanda. Yeah, I think it's great to see there a bit of insight into this section of the shortlist. And just a reminder that shortlist there on a monthly basis for you guys to use as your Lego box to go and build any type of client portfolio locally or offshore. I don't know if there's any questions for Tawanda before we go into our last section. Thanks, Lisa. If you wouldn't mind just skipping on. So we want to just showcase something to you guys that we have Seed has been using for a long time internally in our funds, and that's this concept of structured notes. Some of you may be familiar with it, others are less familiar. It's quite unique investment products. It's not a separate asset class, but it does combine sort of different tools in the investment world to bring unique sort of products at different times to the market. We've built up quite an expertise around this over the years, and we've thought that it's maybe opportune to make some of these solutions available to you guys from time to time. So we want to really showcase one particular note today. Lisa, if you wouldn't mind moving on to the next one, where we want to give you a sense of a note that we've included in our local funds recently, give you a sense of how that note works, and then also just get a sense of interest from you guys. And please do engage with us afterwards if you are interested in these kind of structured notes going forward. So our commitment is that when we find these opportunities, that we will then come to you guys and say, here is an opportunity to invest for your clients. We will do a profit sharing on some of the fees on this, and it could just be that additional arrow in your quiver for particularly some of your higher end clients in the future. So it's really just showcasing this capability to you guys today, and giving you an example of one that we've done at the moment. Thanks, Mike.
Great. Yeah, thanks, guys. And as Adrian said, I think these structured notes, they aren't a separate asset class, but essentially the big picture, what they want to do is try and generate asymmetric payoff. So giving you elements of capital protection, elements of income, and potentially elements of capital growth. So I guess trying to get the best of all worlds. And again, I mean, this note that we're going to talk through, which is we just put into the local funds, does I think tick all those boxes. And as Adrian said, please contact us if you want more information and if this is something that you want to potentially offer to your clients. So yeah, as Seed, we are multi-managers, but we don't sort of put ourselves in a box and limit ourselves to just investing into unit trusts or essentially managing fund of funds or DFM solutions. We multi-managers. We focus on allocating capital to other managers, but we can access these through a variety of vehicles. And this slide just gives some indication of how our funds are currently positioned in terms of the different vehicles. Unit trusts are important. Obviously, they're in the fund of funds. They're then our DFM solutions that we do offer, and they do form the majority of our unit trusts. So they are important. They are popular for a reason, and they are an important part of our toolbox. But then we also have investments into segregated accounts, where it's essentially it's our portfolio that the manager manages on our behalf. We are able to make things a bit more bespoke there, or potentially negotiate better fees. Again, there are pros and cons around it, but it is a tool that we are able to use. We have ETFs where we wanted to get market exposure or specific sector exposure at very low costs to try and keep our costs down. We have other pooled trusts locally. These are sort of trusts that can invest into more private asset classes. Globally as well, they sort of can invest into more illiquid assets, which give us, again, a different type of return profile. And we can even invest in securities directly if it makes sense. So as we mentioned in the past, at the moment in our local funds, we do have some direct bond exposure where the yields on the bonds have just been very attractive. And the one other vehicle that we make use of, which Arjun obviously has mentioned and have had for some time, is the structured notes. So you can see it does form a component of all the funds to a larger extent. That I guess the opportunity set in these notes is bigger in the global side than on the local side. So that is why we've built up bigger weightings in our global and global equity fund. But we do make use of them locally where it makes sense. And as I mentioned, these notes, as any investment will have, is that they do have their pros and cons. But when they're used wisely, that we can add significantly to our funds, limit the downside, ensure they're attractive returns if there's market upside. So if we can then move on to the next slide and just give you some sense of this recent note that we've put in. Essentially, it's the BNP Paribas 136 note. Exposures to BNP Paribas, who's it's a big French bank, A+ credit rating from S&P, so a high quality bank. When investing into notes, you always are taking on the credit exposure of the issuing bank, so that's an important component that we need to make sure we're not going to some smaller niche emerging market bank that's a big kind of too big to fail type bank. With this note, there is no downside. So I've put market risk. There's no downside risk. So the money you invest, as long as BNP is around in 6 years' time, you get full capital protection. The underlying index that this note references is called a multi-asset diversified 5 index. Essentially it's a global index. It's got equities, it's got bonds, it's got commodities, it's got gold in it. A sort of kind of a smart beta type process, as Tawanda was talking about. It's actively managed, but on a sort of systematic basis. The note, and again, with all of these structured notes, each of these line items, we can look at them in different ways. But with this note is priced in rands. So for our local funds, we're wanting to try and generate better returns for our local funds. On the underlying liquidity, there is daily pricing. You don't get the full capital protection on a daily basis, but if you do require liquidity, you are able to get it out at any time. It is mark to market on a daily basis. And then the different thing with this note is that there is then this inbuilt liquidity. So after 1 year, you get 25% of your money back, plus a coupon of 22.5% on that investment. After 3 years, you get another quarter of your money back with another coupon, and essentially then half of your capital sits as a growth play, if I can call it that. And if we go on to the next slide, this can be maybe a bit confusing and a bit more difficult to look at. So what we've done is that essentially how we look at it, we say, okay, we're making a R1 million investment into this note, or into this investment. Essentially, we break it down into 3 underlying investments. It's the same as investing 250,000 Rand for 1 year. And at the end of the year, that 250,000 Rand has grown by 22.5% per annum, guaranteed. Is that something you like? Yes or no? We definitely like that. You have another 250,000 Rand, you invest that for 3 years. At the end of the 3 years, you get a 250,000 Rand back plus 45% yield, which is essentially a 13.5% compound return. Would you like a 13.2% compounded return guaranteed over 3 years? We say yes, and that kind of ticks this box. So with this note, what we've got already is that, as I've mentioned, you've got your full downside protection over the term, over the 6 years. You know you're not going to lose money. Over 1 year, over 3 years, now pulling out a really exciting yield, whether it's compared to local bonds, money market, most asset classes. These are attractive returns. And then finally, the remaining 500,000 that you have to invest from that R1 million, you're investing it into this NAD5 index, so the multi-asset index. But with this index, you're getting full capital protection and 670% of the growth in this index. And to give you some context of what this looks like, on the last slide, if this index ends down, your capital is protected. So you don't have to worry too much about this in terms of if things really go badly. Things go badly, you get your 500,000 back, happy days. Obviously, where this now benefits is if the market really does go up. We've highlighted in green our expectation for this kind of global multi-asset index is for it to do between 0 and 7% per annum in dollars. Obviously, the return is then converted back into rands. But if this index does, as I say, if it does 0%, you essentially get your capital back. If it does 7% per annum, we would get a 30% return per annum in rands. The expectation from our side in terms of where we would expect, we expect the return to be around 5%, maybe slightly lower. But ultimately on this leg, we're looking for a return of around 20% per annum over the 6-year holding period. So again, we've got 22.5% return after 1 year. Your 3-year, you're getting 13.2% per annum, and those two are guaranteed. Finally, this return, obviously, that's the growth leg, depending on market returns, capital protection, expectation of around 20% per annum in rand terms, and the optionality that if markets do well, we can get up to 30%, and if things really do fly, obviously the upside is not unlimited, but you are participating in the upside. There's no cap to the performance on this index.
Thank you, Mike.
So, yeah,
that's probably quite a mouthful, but we really just wanted to showcase this in-house capability. Gemma, there's a question from you.
Sorry, I'm on my daughter's Teams. It's Yolandi, and I accidentally clicked on
Sorry, Yolandi.
Sorry.
Do you have a question, Yolandi?
I don't have a question, no. But I mean, this is brilliant, and I mean,
Okay.
the great side of this is that there's liquidity in this as well. The other guaranteed investments that we've got don't have the liquidity, so that's superb.
Yes.
Yeah.
So the notes are. Sorry, Yolandi.
Sorry, is there some marketing material for us on this?
So this is a note we've just invested in, and we're just using it as a showcase. So the window on this is actually closing. I think of the 150 million, there's only a 5 million capacity left. So the idea behind this is really just to give you a sample. None of these notes are exactly the same, but we are working with the Causeway guys and the derivative desks to explore these on an ongoing basis. And what we want to inform you guys about is then if we find a good opportunity like this on an ongoing basis, which we do, we want to then make it available to you and your clients, and we will communicate around that going forward. So this was really just a teaser or an appetizer of what we do in the background and what we will be bringing to you guys in the future.
Awesome, thank you.
Any other questions, guys, for any of the team members?
I just want to know if there is a minimum investment for that note.
Sabian, so we will set that with each note. We can actually set that. We're quite flexible on the parameters and also on the sort of commission structures. So as we make the notes available, we will communicate the minimums, the commission structures, and how they work.
Yeah, I think
Thank you.
from our side, the key from today is that if this is, I guess, the kind of return profiles and you have clients who potentially have these requirements as to get hold of Adrian or get hold of Miguel, if you can express your interest, we obviously from the investment side, we're looking at these kind of things on a continual basis, and where there is interest in it. If Miguel and Arjan know that you are interested, you potentially have clients, when we do line up our next investment. And again, I think the intention is that we're going to be offering notes that you'll be essentially be co-investing alongside the seed unit trust. So we're not kind of trying to push product here. It's just a case of potentially bespoke instruments and bespoke notes that we design for our funds that are relevant to individual clients to invest in directly, and by using our bulk with our unit trust to be able to offer it to this kind of more retail investors, which is typically not otherwise available.
Thank you, Mike. Guys, also just on a different note, you'll get a WhatsApp with an article that was published today on Seed and CityWire. You might have to register for CityWire to read it. We'll send it out. We want to encourage you to read that article. We'll give you some good insights around Seed. And also, I think if you do subscribe to the CityWire, you'll get some really valuable information on funds and the local and offshore asset management landscape. So probably a worthwhile subscription to do. Thank you for the comments. We appreciate that. And as always, the team is available. If we can help with any client portfolios or any investment advice, please reach out to us. And we look forward to seeing you at the next session on the 16th of August.